Hi everyone, good morning. Welcome to today's Fireside Chat with Mr. Harsha Upadhyaya. Harsha is the CIO Equity and Debt at Kotak Mutual Fund. He manages about 75,000 crores of assets under management. A quick introduction about Harsha. He's an engineer from National Institute of Technology at Surathkal and an MBA from IIM Lucknow. He's also a chartered financial analyst from the CFA Institute. Harsha has a rich experience of over 26 years spread across equity research and fund management. His previous stints have been with organizations such as DSP, BlackRock, Prabhudas Leeladhar, SG Asia Securities, Reliance Group, and UTI Asset Management. And I'm not done with his achievements here. Harsha used to be a university hockey player. He's a voracious reader and big time into fitness. We are lucky to have him here today with us as we talk about the markets and the impact of the budget and the way forward. Over to Amitabh and Harsha.
Hi, Harsha. Welcome on board.
Hi,
for this
Amitabh.
Yes. So it's obviously our pleasure, and we have been fed with a lot of questions by the audience already in terms of what to ask you. So you'll be on the spotlight, and we have also thought of a unique segment where we will have kind of a rapid fire, but that will be towards the end of the session. So we'll see
But
how
there's
you
no
perform on the
hamper,
spotlight.
Harsha, there's no hamper.
Yeah, I was going to check with that.
So let's dive straight into the topic. And I think while we go to the economy, etc., and I'm sure there's a lot of insights which we'll get from you. The most recent event was the budget. And of course, it was an interim budget. But your quick take on the budget and how should we look at it?
Thanks, Amitabh. Good morning to everyone. See, as far as the interim budget went, I think market was expecting that it will be more populist oriented, given that we are close to central elections. That was one of the concerns, I would say. And also there was a bit of a concern that given that our fiscal deficit was at a higher level last year, and even this year when we end, we will be at a reasonably high level. And there is an FRBM roadmap to which India will adhere to. Given these constraints, there was a concern about what kind of capital expenditure will happen, because that's really necessary for us to build on the current level of growth and continue growing at a reasonable pace even going forward. And also what kind of net borrowing would that entail, given that that will also have impact on the yields. I think these were some of the key questions that most market participants were trying to find answers for. And as far as the interim budget is concerned, I would say that it has ticked all the boxes that everyone was looking at. First and foremost, there has been no taxation change. So these days, no news is good news, right? Especially on taxation. So that's one positive as an individual, as a corporate. The second is, if you look at the fiscal deficit roadmap, I think government has done really well there without cutting on necessary expenditure, and they have managed to bring down fiscal deficit in a COVID-affected time period. And also now, as you look forward, the budgeted fiscal deficit is 5.1%, which is much better than what market was anticipating. I would say even if it was 5.3 or thereabouts, I think market would have been fine, but 5.1 is definitely very good. And while doing that, we have not seen any major cut in capital expenditure. The most of the cuts have been on the revenue expenditure side. So to that extent, while there is a moderation compared to the previous year in terms of capital expenditure, it is still growing at a pace which is higher than the nominal GDP growth. We are likely to grow at about 15%. While one may have wanted the government to be at a higher fiscal deficit and higher expenditure to go on capital expenditure. But this also has some positives in the sense that it will not crowd out private investments and helps bring in private investments at some point of time post-election. So I think all in all, fiscal deficit and the trajectory on capital expenditure seems to be better than what market anticipated initially, I would say. And the net borrowing number is also much lower than what market was expecting. In fact, if you have seen the kind of euphoria that's been on the fixed income side, you will notice that the yields have collapsed to about 7.07 now thereabouts, which is clear indication that market was worried about the kind of net borrowing levels, and the borrowing levels have been much better, which will also have a positive impact slowly on equity markets. One, there is an inverse correlation between equity valuations and the interest rates. So as interest rates go down, equity valuation should move up. Secondly, although most of our corporates are not really leveraged ones, but to an extent, marginally, they will cut down on the interest burden also if interest rate trajectory is down. So these are the positives that we see from the budget. I think final details will be available once the government is sworn in and the new budget is presented. But more or less looks like the medium-term plan or the long-term objectives will be kept in mind, and we will continue to move in that direction. So that's definitely a positive.
Well, I think budget is just one of the steps in this year where there are so many things happening. The general elections coming up, the US elections much later, whether US will cut rates or not. So what is your take on some of these other key indicators, and your take on them from a market perspective?
See, first and foremost, I think India is not completely correlated with what's happening in the global economy or politics, I would say. And the numbers are in front of us, right? Even when the global economy is down and slowing down, we have been very resilient, and we have been moving ahead at a reasonable pace in terms of growth. Now, clearly, I think even from a global perspective, things are improving. In the sense, inflation is broadly under control in most economies. Fed, as you rightly mentioned, is likely to pivot sometime during this year. The market expectation is at least 2 to 3 interest rate cuts starting maybe middle of this calendar year. And India, anyways, has maintained a tight leash on inflation. If not for developed markets increasing rates last year, maybe we could have seen a reversal in interest rate trajectory in India. Definitely, when US Fed and other developed nations will start looking at cutting rates, I think we will have more leeway to do that. So India should also broadly see interest rate cuts during the year. That's definitely something that will be a positive. Right now, there are no big red flags from a global economic backdrop, I would say. But one has to be ready for any kind of events. There will be some unknown events that will come and hit every now and then. There will be volatility in the market. And also, as the valuations go up, one should be really ready for seeing that higher volatility. Politics, at least from a domestic perspective, now seems like the consensus is building that the current political establishment will come back in some shape and form. So to that extent, as you would have seen post-state election results and a couple of other political parties joining NDA alliance, we have seen more of positive sentiments in the market. So as long as those expectations are met, I think markets will continue to remain strong. US elections, I don't think that will have too much of impact on Indian markets per se. Maybe there will be some knee-jerk reaction here and there for a couple of trading sessions, but I don't think it will have a very meaningful impact from a longer-term perspective. That's how I see it.
Fair. Now that's good to know. Now you're handling 75,000 crores of assets. That's a very large number. And as you look at where to deploy them, what are the things which you are looking at from the current market? Which place where you see the opportunity, or is it time to be defensive? How do you see that today?
See, all of us have been cautiously optimistic. Why cautious? Because of the way markets have behaved in the recent times in terms of very, very strong returns that we have seen. We have seen close to 35% plus kind of CAGR, especially at the broader end of the market. Even if you look at large caps, they have given 15% plus in the last 3 years. Last year has been very, very strong once again. So given all this, as markets move to higher levels, one should be a little cautious of valuations, because markets are never one-way street. No business can continuously grow and create wealth. There will be cycles. So that being said, I would say that our focus has been on domestic businesses. Not now. In fact, sometime after the first COVID disruption that we saw, we started tilting towards domestic theme, given that our economies look more resilient as compared to global growth, and that still continues. This year, for example, in 2024, we are expecting global economy to actually grow at a slower pace than 2023. And that's also leading to interest rate cuts, right? So while expectation is global economy will continue to remain subdued, we should continue to grow at a reasonably high pace. And that's definitely a positive. And within that, the domestic oriented businesses will continue to deliver better growth trajectory and also better returns for stock investors over a period of time, in our opinion. Within domestic, obviously, it opens up a large basket once again. I would break that into consumption and non-consumption basket. And between the two, I would say we are more positive on the non-consumption space, which is there may be few consumption oriented. For example, auto is a discretionary consumption sector, but I would say that when I say consumption, it's more of FMCG and staples, that kind of a business. Between that and the cyclical bucket, we are more positive on the cyclical side. The valuations will have to be analyzed. Every sector may not give you uniform kind of upside. Within sectors also, there will be a lot more stock-specific opportunities, because by and large, market is at a reasonably higher level of valuation. So I don't think you will see uniform rate of return across the sector. Keeping those in mind, I think the opportunity is still significantly higher on the domestic cyclical side.
Right. So when you say domestic cyclicals, would you be able to give us a few examples of what you mean by domestic cyclical, so that the audience here would be able to better understand that?
Definitely. If I have to name a few sectors, I would say auto, industrials, cement, many of the other manufacturing sectors. We are also positive on the energy sector, both oil and gas as well as power. So there are many of these sectors which are depicting very, very strong tailwinds in terms of demand factors or in terms of capacity additions, all of that. And if you look at next 2 years of projections, many of these baskets are likely to grow at a pace higher than the average market earnings growth. So generally, when you have sectors showing higher than market average earnings growth, you will see outperformance coming from those sectors, unless those sectors are towards the end of the cycle or have huge valuation risk. While there are some stocks within each sector where valuations are very, very expensive, but I don't think you can say that this is a market where you should start trimming your equity allocation. In fact, this will be more of a buy on dips kind of a market, and equities will definitely remain one of the favored asset classes in that sense. So I would say all of these sectors will continue to offer more opportunities than global facing sectors. I'm not saying that global facing sectors you will lose money, but probably the wealth creation will be a lot slower in that bucket unless we see a complete turnaround in global economic situation.
Right. See, one of the things which you mentioned just a while back, that within, when you compare with consumption and the other basket, you said the other basket has more potential currently. One of the thoughts we all had in terms of from an India perspective, that the per capita GDP is growing per year, and that is leading to discretionary consumption going up, and that to be a much more secular trend if you look at the next 3, 5, 7 years. How would you look at that? So both from a short term, I understand there could be challenges, but from medium term, are you comfortable with that, or do you think that that is something where one should be more cautious?
Amitabh, as far as consumption is concerned, I'm only looking at better entry points. I'm not negative from a medium to long-term perspective. Clearly, we have seen a J kind of a curve across various other economies when per capita GDP, for example, moves towards that $3,000 or so. We are close to that level now. So in next couple of years, definitely we should be moving towards that level. So I think We are already seeing a bit of that. If you look at urban consumption or high-end consumption, for example, has been very, very strong. So there are two halves in the consumption today. The sectors which are more at a basic level of consumption or rural-oriented consumption, for example, that has slowed down, and various factors for that. One biggest factor has been the COVID disruption, right? Many of the migrant population went back to their hometowns from cities during that period. They couldn't come back to their workplaces immediately. Probably they had lesser savings as compared to urban population, and they used up all that savings. And now that they have started to come back to the mainstream workforce, you will see the savings getting built up once again. But this year monsoon was also deficient, so that also lowers your confidence on consumption. So these are some of the factors which have held rural consumption and lower ticket consumption at a slower pace than what the market would have ideally liked it to be. Usually in a pre-election year, you see a lot more strength in rural consumption, for example. This year, maybe because of the earlier two factors that I mentioned, you have not really seen the full impact of pre-election spending in rural areas. But at some point of time in the next couple of quarters, we should see a turnaround in rural consumption as well, provided we don't have a second bad monsoon. So I'm not saying that from a medium term, there is no opportunity in consumption. All I'm saying is, given higher valuations and continuing sluggish trends on demand, probably it will not be as good as some of the other domestic cyclical themes at this point of time. But definitely one should keep an eye on this. And as India becomes more prosperous, you will definitely see many of these segments growing even from the current level.
Fair. Now, what I would do, I'll want you to don the hat of a CIO. And then, so when you look at it from how to manage the funds, so there are a lot of best practices globally, internationally. And so how do you look at global practices and see what is it that should be there at Kotak or at when you're managing a fund? So is there anything which you bring in from across to kind of the way you manage funds?
See, broadly, we have been managing most of our funds with a very good discipline in terms of investment discipline. When I say discipline, it doesn't mean that we will be able to outperform across cycles, across funds. There will always be periods of underperformance and outperformance, but we stick to our discipline and we don't change our investment philosophy because something changes in the market. At the same time, we are not completely foolish that we don't realize the changes that necessitate some kind of flexibility in our investment approach as well. But broadly, the larger boundaries that we have drawn ourselves continue to remain as Lakshman Rekha, I would say. There are many things that will keep adding to this investments discipline. For example, globally, technology is being used a lot more in research and investment management. I don't think we can wish away that fact. So we are also taking very, very baby steps in terms of how we can improve on our research, especially in terms of efficiency, because currently our coverage universe is close to about 430 stocks. And as markets, Indian markets offer more opportunities in terms of more businesses, etc., and also as we start managing larger amounts of money, we will need to bring in efficiency in terms of research and investment management. So we are looking at various things in terms of how to make sure that some of the routine and standard processes can be automated and technology can be used to increase that efficiency. In fact, on the investment side, in fact, we took a baby step about 6 months back. We launched a fund called Kotak Bond Fund. So this is a combination of human intellect and machine algorithm. We looked at removing human bias from investments. Sometimes the biases give you positive performance, sometimes they give you negative performance. Is there something that we can remove human bias and can we contribute more? The one serious aspect is you can do that by going passive, right? You remove all biases, you just replicate. But the problem there is you will never get outperformance. You will always get something lesser than the benchmark, because that's how that is designed. So our starting point was, can we do something where we retain the potential for outperformance while removing human bias? So we recruited resources from IIT Kharagpur and IIT Mumbai, who are the brains behind this algorithm. And we came up with a model which has been backtested between 2005 April to June 2023. And we found that momentum as a factor drives markets over the long term in a more sustainable fashion. If you have factors like quality, growth, value, etc., there are typically cycles of few years and then it changes. Right? But momentum is the collective wisdom of the market. Wherever there is interest, the momentum builds there. It could be value, it could be quality, it could be XYZ sector, it could be anything. So that's how we zeroed in on this particular strategy. And the way we do it is in any momentum oriented strategy, there are passive indices as well, right? NSE Momentum 30, for example. But the downside there is anything that depicts higher momentum comes into that basket of index, right? So you have no control on something which you are not comfortable as a business, as a management, etc., or as various other factors, because it's purely picked by the computer and the weights are the same. So our starting point was, can we do something where we will not pick a stock which is unlikely to come into our active fund, whether it is Kotak Flexi Cap, Emerging, any of our active funds. But at the same time, can we remove human bias? So that's what we attempted through this. So we have taken our own investment universe. As long as our universe is picked, then we have comfort on the business value. Valuation is a separate case, but at least the governance, etc. So we won't take any subjective calls on valuation. We let them machine to pick up stocks and assign weights. So it's been a short history. It's been about 6 months, but the results have been quite strong. In fact, more than what we anticipated. So we'll build on this technology side as we go ahead much more, I would say.
That's very interesting. So just taking a couple of questions on Kotak and some funds, just to so from in this market environment, especially as we look at, we spoke about, there are opportunities. If somebody is wanting to add funds at this point of time, would you suggest which space should one look at? Is there a fund which you would recommend within the Kotak basket? I understand that customer needs. I understand all of that, and I'm just taking that out for a second, just to say that, is there a fund which you think in this kind of a market, somebody who's looking at moderate growth and wants to come in, what should he or she do?
Amitabh, clearly, I think the allocation to equity should be at the intended level at this point of time. It can be slightly higher than intended level also, because we continue to remain bullish on equities as compared to few other alternate asset classes. Having said that, I think investors should also moderate expected returns going forward, especially compared to the recent history, because generally there is a tendency to look at very recent history and expect your future movement also in that regard. So that's where I think the current 35% kind of CAGR cannot continue for a long period of time. If it continues, it's a bonus. If it continues, then probably it will continue with higher volatility than what we have seen in the last 3 years, because valuations have also moved up. So that's something that one should keep in mind. But overall on equities, we continue to remain quite positive. Within our basket, I think we have multiple funds which can suit each investor's needs. Starting with passive funds, which are really, really conservative in terms of taking equity risk. Then to active large cap oriented funds, to completely small cap oriented or thematic funds. So depending on each one's risk profile, you will have something or the other that is suitable. Broadly, we are positive on equities. So anything that you pick should give you reasonable returns. Since you said moderate returns, I'm pretty sure that most of these funds will be able to tick that box. But if somebody is looking at let's say thematic exposure, then probably I would suggest manufacturing from a 5 to 7 year perspective. We had seen mid 90s to early 2000, etc., where IT outsourcing was a big theme, right? Not just in terms of the business growth, but also in terms of the stock market fancy. That played out. Post that, we had infrastructure and construction related boom for about 5-7 years until the global financial crisis. Thereafter, we had the financials really doing well, especially the private sector financials, both in terms of business as well as stock market performance. Then we had the consumption basket doing pretty well. So we have seen these larger cycles of 5, 7, 10 years where a particular theme really does well in terms of business and continues to grow at a pace higher than that of the market average earnings growth. And in that period, naturally, the valuations also get re-rated. So I would say manufacturing could be that next theme. And also it offers you a lot of flexibility, right? Both as an investor, as a portfolio manager. It's not one or two sectors in the fund. Nearly 45 to 50% of the market cap is available for investment. So what it doesn't invest into would be banking and financial services, IT, hotels, telecom, and such services. But apart from that, rest of the market is available for investment. So that's where I see a larger opportunity. Obviously, thematic funds cannot be a large proportion of one's asset allocation. But if one is prepared to take slightly different asset allocation route within equities, I think this thematic experience can be good.
Excellent. So now we'll give you a very short break for a sip of water. And
Okay.
What we will do, post that, we will move to the rapid fire section. Anulekha, you want to take a couple of minutes till Harsha catches his breath?
Yeah, and maybe everybody can think of questions for him till then. So, guys, the biggest announcement of 2024 is here. We are migrating to a completely new backend software. We are soft launching it today, and this will give you a better experience. And I promise you, the speed is much faster. In addition to the website login, we have our own app for both Android and iOS. It's now available. So our team will get in touch with you over this month and send you the new user ID and password so you can access your portfolio conveniently and faster from the comfort of your phone and of course from the new website also. We had launched the website in early Jan this year, and I hope you had a chance to go through it. If not, please do and share your feedback on the same. And now moving back to Amitabh for the rapid fire round with Harsha with no hamper. Let's see how many spontaneous answers we can get from him.
Harsha, are you ready?
Yes, Amitabh.
Okay. So first, a very serious market question. What is your favorite eating joint in Mumbai? I'm going to confuse things up.
Home.
Okay, that's a brownie point earned. Bull or bear market, your current sentiment?
I would say bull market from a longer term, but you will face volatility at various points of time, but nothing to really fear.
Top 3 factors you consider before making an investment decision. Very quick 1.1s.
Business, management, and valuations.
Thank you. Your take on the current global economic outlook in 3 words.
Subdued and slow.
Okay, that's in 2 words, but that's absolutely spot on. Value investing or growth investing?
Growth investing at a reasonable price.
Okay. A book you love outside the investment world?
Okay, Prisoners of Geography, I would say. It talks about the geopolitics and the physical borders and the relevance of physical borders.
I have heard a lot about it. We were debating about it some time back with somebody else. So interesting. I haven't read it. I will go through it. Active management or passive indexing?
Active management. I have to earn a living, Amitabh.
Absolutely. So do we. Economic indicators or market sentiment?
Both.
Okay. That's hedging the position. But yes,
But you
I
have
guess
to,
so.
I don't think you can ignore any one of them.
Absolutely. A fund manager or fund house beyond Kotak you admire?
Or many, I would say. I would not like to take any one name, but all those who have managed a long period of time and created wealth, they would have seen multiple challenges. There are challenges in terms of cycles. There are challenges in terms of the asset size, whether it is private or public, etc. And public, of course, has a lot more pressure that's built on because everyone watches you. So I would say anyone who has been in the industry, whether in India or outside for a long period of time, you have to learn something or the other from them.
Absolutely fair. And in the role which you are in, I'm sure you're constantly under scrutiny. What keeps a Kotak CIO awake at night?
Oh, nothing. Actually, I sleep quite well. So
That's good to hear.
it doesn't mean that I'm undermining the risks that are there in equity investing. I'm just saying that I don't worry beyond a certain level on the portfolios. There will be volatility, there will be mistakes that will be done, but I'm a peaceful sleeper, touch wood.
Touch wood. And I think that's a good thing to have. One thing in investing that you will ask your daughter not to do.
Ignoring fundamentals.
Fair. I think that's that's something.
You can't just blindly chase momentum. You have to keep an eye on fundamentals.
I mean, like all the questions I had, he has been answering very promptly. So you have to find a gift hamper for him. How you'll find is
when
up to you.
Maybe I'll visit you and collect it.
Right. So what we will do now, so as we come to the end of the rapid fire section, we will now move to the Q&A section. And in terms of question and answers, I would request all our guests to either put it in the chat box, or if somebody is wanting to ask a question, then let us know, and we will. I can see a question coming in from Mr. Pratap Chatterjee. So if you want, you can unmute yourself and ask the question. Or would you want?
Good morning. I think the question is clear. I mean, if there is an El Nino year this year, which is unfortunately maybe the reality, is there any sector which you think will still continue to do well? I mean, we all know that which all sector will not do well.
So, as I said, broadly, most domestic cyclical sectors will continue to do well. Yes, if consumption doesn't take off, something which is closely related to this year's consumption demand will continue to face issues. But from a slightly medium-term perspective, I would say most of the domestic industries are doing well. In fact, if you look at the breadth of the market in terms of earnings trajectory, you'll be surprised to see how we are doing. For example, in the COVID period, just in financial year 20, Nifty was about a 3 lakh crores in terms of profits, and about 60,000 was coming from the rest of the NSE 500 bucket. Now both of these are at about close to let's say 7. Nifty has gone to about 7 lakh, and your non-Nifty basket of 450 companies have actually moved up to almost like 3 lakh crores. So there has been a huge improvement in the breadth of businesses which have started to do well. Yes, this is the initial phase of the cycle, so more companies are likely to get that kind of benefit. As a cycle matures, probably we'll see more headwinds, etc. But broadly, I think most of the domestic businesses will continue to see a very, very strong earnings trend. So nothing to worry. Maybe if some of the external factors affect, a couple of sectors will continue to face those headwinds. But broadly, India should continue to deliver mid-teens to high-teens kind of earnings growth for the next couple of years.
Right. I have a question which, Ketan Bhai, I think you have asked a question. If you want, you can unmute yourself and ask the question. And
I just wanted to get your opinion or your outlook for the textile sector.
Textiles, unfortunately, is not something that as a public market investor, we are really looking keenly, because one, the sector is very small in terms of the opportunity that it offers. We can't deploy large amounts of money into that sector. Yes, we do have a couple of names in the sector, but I don't think it'll be one of the focus sectors in that sense, even going forward, at least in the near term.
Thank you.
Dhiresh Bhai, you want to ask a question?
Yeah, I wanted to ask regarding a chemical company, a typical B2B sector undergoing a transformation journey. So how would the market adapt to that, or what would be the reaction of that, looking at the perspective of a transformation journey for in the next 3 to 5 years? So I just wanted your opinion on that.
We have been quite positive on the chemical sectors, although in the calendar year 2023, for example, many specialty chemical segments and commodity chemicals have seen kind of a pressure on margins and pricing, mainly led by global destocking. But from a medium to long-term perspective, I think the opportunity in front of Indian chemical industry is very, very large, I would say. If you look at even today, China accounts for almost 70% of the global chemicals trade. Right, so it's the dominating region in that sense, and we all know what's happening with respect to China in terms of geopolitics, in terms of how global majors have been trying to diversify out of China, at least for the incremental supplies, because it's been a big risk, and which people have realized during COVID and post that, and that trend still continues. So I think India, which is probably about 4% of the global chemicals trade, can be a challenger in some sense to get a shift away from China in terms of the intermediate supplies. That trend will continue. So medium to long-term growth is definitely there. And the fact that most of the chemical businesses have been increasing their capacities, have not cut down on their capacity expansion plans from a medium-term perspective, also suggests that the businessmen are confident that the destocking cycle or the pricing pressures that we are seeing in the sector is at least according to them, is not a long-term problem or a medium-term problem. And hence they are going ahead with creating more capacities. So I would say, yes, in the immediate scenario, maybe there are slightly better manufacturing sectors, purely from a stock market perspective, where earnings growth is better and probably they'll do slightly better than chemicals. But from a medium-term opportunity, we are still quite positive. In fact, across our funds, we kind of have a overweight position on the chemicals segment.
So Harsha, just a follow-up question on this. For a chemical company which is unlisted, a healthy debt-free company on a transformation journey, now it requires some funds to go and embark on the next journey. So what would you advise? 3 options we all know: private equity, a strategic investor, or a IPO route. So what would you advise to a company like this, and why?
I would say it depends on the stage of the business. And as a public market investor, I would always suggest IPO route, because one, we get an opportunity to participate in that growth. Second, you as a promoter also have a diversified investor base. And by getting into the listed space, that also enhances brand and reputation, right? So there are various other tangible benefits that you will gain. However, if it is a smaller in size, probably going public may become difficult or may not fetch the right kind of valuations. So in those cases, generally private equity is preferred, but it comes with its own advantages and disadvantages. Advantages that rather than talking to a multiple set of public institutions who manage your public money, you would be happy to engage with a couple of institutions, and it will be more of a one-to-one kind of a discussion, and then you can raise that money. But it also brings in a lot more other issues, as in unlike mutual funds or public market institutions, private equity funds may not be happy with just acquiring a stake. Maybe they would ask for a board seat. Maybe there will be some pressure on at what pricing you will be going public later on, because they would also be offloading their stock, etc. So both will have positives and negatives. But I think if you have crossed a certain size and if you're okay with the public scrutiny in that sense, I think IPO would be better.
Okay, thank you so much. So the size about 1,500 crores we already crossed, and now the option remained between, so private equity kind of, even we were not so keen, but IPO or strategy. So again, IPO route may be a more preferred one, right? That's what we're saying.
See, strategic, I think I will not be able to offer any suggestion there, because you will be the best judge of your business and who can bring in that strategic input in a way that you'll be able to expand business. So
sure,
I hardly have any opinion.
No, I understand. Thank you so much. Thank you for your insight. Thank you.
Thanks, Dheeraj bhai. We have a question from Nitish. Nitish, you want to ask?
Yeah. Thank you, Amitabh. Hi, Harsha. Actually, this is a very simple question, but very complex in the nature that is always in our minds regarding the mental turmoil which we face with regards to whether we should invest directly through stocks or indirectly through mutual funds route. Because number of times my friends who are always there in the stock field, they say that they have got this 40% return in the last 2-3 years. And here Amitabh in his Fission Wealth is not allowing me to go to mutual stocks, and he is giving me good returns. But there is always this kind of turmoil which is always happening between whether to invest directly or to go to the mutual funds route. Your comments, please.
Yeah, before he comments, I never stop you. Over to Harsha.
And no, Nitish, nobody tells you about the losses they make in the stocks.
That's true. That's true.
Over to Harsha.
Being a mutual fund portfolio manager, I will also have similar views as Amitabh, I would say. The only thing I would add is, if you are able to analyze businesses and stocks and valuations especially, and if you can devote as much time as a professional investment team would devote, then going directly into stocks is not bad. But most often the stocks are bought and sold based on someone else's wisdom, someone else's analysis. And that always has some downside, and it can be serious downside as well. So if you are able to analyze businesses like any other professional investor, one can go directly into stocks. And also secondly, Anulekha mentioned about not disclosing the losses that many people make. The second is also how much money you will actually invest in stocks. It should be proportional to your wealth. Then only it will create you that kind of overall returns on your portfolio, right? For example, a lot of people get excited about IPOs getting listed at a very significant premium, and they participate in almost every other IPO. The question is how much of your wealth is going to get invested in IPO at the allotment stage. I'm not even going to whether they're fundamentally strong, etc., etc. But I'm saying that you will not be able to invest a significant sum of your wealth in any of those individual names. So you may make a very large return, 70%, 80% on listing, as what is happening now. But can you compound your money at 70%, 80%? The answer is no. So I think whenever you make these decisions or whenever you discuss a particular stock, you should also see how much of your portfolio can be invested in that particular stock and what volatility it will bring to your overall portfolio. You may get higher returns, but it will also probably get you higher volatility, right? And that's the reason why mutual funds, after having professional investment teams, we don't invest in 10, 15 businesses, right? So we invest in 50, 60, 80 businesses, because there is always a chance that you will go wrong despite doing all of your checkboxes. So in that sense, I mean, it depends on how much you can spend in terms of researching these companies. And secondly, whether the positions that you will take will be proportional to your wealth and whether that can really give returns on the overall basis. I think that's what you need to think about.
Thanks, Harsha.
Thank you, Harsha.
Amitabh, Vikram, would you like to ask your question?
No, Anulekha, you can go ahead, please.
Okay. Vikram has asked, everyone is assuming that the government will come back with a similar, bigger mandate, and market sentiment is generally strong with this assumption. What would be the outlook and long-term effect if there is a major upset to that?
See, clearly, whenever there's an event, it depends on what the collective expectation of the market before that event and how that event pans out. Because most of the collective expectation would have got discounted in the market before the event. So if there is a disappointment, that is going to have some impact on the outcome in the very short term. Having said that, if you plot Sensex or Nifty from the date of inception until now, you will not even realize when were those central elections were held in the last 30, 40 years, right? That's one of them. Secondly, it doesn't mean that market knows everything and behaves in a rational manner in the very short term. For example, in 2004 and 2009, the initial reaction of the markets and the subsequent 5 years of performance are a testimony to that, right? Initially, markets may have been very, very nervous. Maybe we hit the lower circuit, but the next 5 years were reasonably strong. In one case, initially market was very euphoric. We hit the upper circuit, but the next 5 years were not great. So as long as the policy environment remains stable and positive for corporates, as long as economic backdrop is strong, then I think give or take with some volatility, you should continue to progress well. But if there is any change to external environment or if there is any serious change to the policy framework, then we will have to analyze from that prism.
We have a question from Sanjay Nagpal. Sanjay, you want to ask?
Amitabh, before answering that, I just remembered the numbers that I gave on NSE 500 and Nifty profitability. I gave the latest numbers as of 6 months. So whatever numbers I said, if you analyze, probably it will be 2x or 2.1x of that number. So broadly, the broader market has compounded earnings at about 35 to 38%, broadly in line with how markets have performed in the last 3 years. Yeah, sorry, I'll take the next question.
Hi, thanks, Amitabh. Hi, Harsha. This is Sanjay Nagpal. I had been a banker throughout, so I am asking a related question to me because I am heavily invested into the banking sector. So I thought that how and what is your expectation? Where you see banking sector going from here now? Given that this time they were expecting the rate cuts, but they didn't come through. And I don't know whether it will coming soon or not. Plus, RBI governor at one point of time talking about the credit and the asset ratio for the banks, that the deposits and the credit given by the banks. So that was also at one point of time looked at it. Maybe there was public sector banks who were little beneficial given their lending side and the deposit side, but I don't know about private sectors. So they have not been able to match up to that expectations. So your view specifically on the banking sector, keeping all these points there. Thank you.
I'll probably give a slightly longish answer, taking you back to the period where they outperformed, etc. Before that, you are right. From a immediate perspective, there is going to be a scramble for deposits because, especially after the taxation change, people have started to look at equities rather than debt instruments or fixed deposits. So that's putting some pressure on cost of funds because if you don't have a strong CASA base, your cost of funds are likely to be slightly higher. So you may not be able to manage your net interest margins. Kind of belt. If you look at in terms of the credit growth has to continue at a higher pace. While the regulator has spoken about credit deposit ratios, etc., but they've also clarified that they don't have any number or a ratio in mind. So they're not going to regulate that banks will have to X and Y kind of CD ratio for requirements. So to that extent, I would say these headwinds are more of a immediate issues. But the other part is the larger philosophical question. If you believe that the growth for banks is going to be challenging, then I think some of the positive expectations that we have on the market can also not continue. If our economy has to grow at 7.5% in real terms, definitely credit growth has to remain strong. Now, the bigger question is who is helping that credit growth to continue? If you're saying that banks are unable to lend, if you're seeing retail portfolios are getting tilted towards equity. So corporates are unable to raise money through fixed income papers. There is no retail direct participation in fixed income. So if all of this is happening, then who will fund the growth that is going to come? So either the market valuations will have to come down or the credit growth has to remain strong. So from a medium to long-term perspective, I don't think you can ignore banking and financial services. Now, just stepping a few years earlier, this was a segment which was growing at a higher pace than the market average earnings. So I'm talking about the larger sectors. Right? So whenever you have a particular theme growing at a pace higher than the market, obviously there will be re-rating in the market. And that's what we saw, where large banks, including the entire sector, performed really, really well. Now what is happening is, while they continue to grow at a reasonable pace, maybe slightly lower than what the market is anticipating, but still a reasonable growth, I would say. The change that we are seeing is the rest of the market is exhibiting even larger amount of growth. Right? So that is where the re-rating of banking and financial sectors may not happen to the same extent. If you have heard my earlier comments on the manufacturing as a theme is likely to offer you better growth going forward. So probably if you're looking at a very, very long cycle of 5-7 years, probably non-banking exposure will do better. But it doesn't mean that banks will give you negative returns. It may not give you the kind of returns that the earlier cycle had presented, because simply this sector was growing at a higher pace and the rest of the market was not growing. Right? The average earnings growth in that period was probably 5 to 7%, whereas the banks kept growing. So it was the only pocket which was kind of doing well, and hence the valuations were very high. So that's how I would say. We are not negative on banking and financial services, but obviously it's not going to be the leader of the next cycle in that sense. Probably there'll be other sectors.
Thanks so much. Good insight. Thank you.
So we have a question from Shailesh Rajadhyaks. What do you want to ask?
Yes, good morning. Actually, what SIP will have a role? I mean, because few people, I mean, most of the people can't invest, good amount. And if they are having a less amount, how SIP will be helpful?
No, I think SIPs can help anybody, irrespective of the amount of money that one wants to invest. Okay. SIP is simply, makes you more disciplined in terms of investments. Point number one. Okay. Second, it makes you manage the volatility that may come in the market every now and then. For example, in hindsight, maybe, in fact, I've received these questions from our investors and our partners many times in recent times, that you have been always suggesting SIP route, but had I invested lump sum money 1 year back, I would have made more money. Yes, but that wisdom is available only on hindsight, right? How next 1 year is going to behave in terms of volatility or in terms of returns. So we can have a view, but I don't think we will be exactly knowing how it goes. So to that extent, if you are putting money through SIPs, it makes you buy at various points of valuations, various points of the cycle. Second, it brings a certain amount of discipline. So the biggest problem that most investors, including professional investors, face is waiting for an opportunity to enter, right? So nobody can time. Everybody wants to invest at lower levels, but whether those low levels come in front of you as an opportunity, or whether you can predict them, and whether at that particular point when a lower valuation is offered, whether you're in a position to invest. For example, the COVID fall was the best opportunity, right? Because the valuations were very low. How many of us were able to really invest all our money during that period?
Correct.
So there are various such questions that come to mind. So I would say because of the discipline and because of the fact that it helps you wade through volatility, I would say it's a best way of investing.
Yeah. Thank you so much. Thank you, sir.
Thanks a lot, Harsha. I'm very mindful of the time. I know you have been traveling and you have taken this call. So maybe what we'll do, other questions, if you have, please do continue to share with me. We'll try and respond to you separately. Any closing comments, Harsha, and really appreciate the time you've taken.
I would say any investor who wants to create a sustainable wealth, I think 3 important things to remember. 1, asset allocation. Second, long-term focus. And the third, regular and disciplined investments. I think if you keep these 3 in mind, yes, there will be periods of disappointment, etc. But I think overall, when you look back after 10 years, 15 years, 20 years, you'll be in a better position.
Thanks a lot, Harsha. We really appreciate the time you have taken today. Not surprisingly, we ran out of time rather than questions, and your wisdom and your experience is valuable. These are very different times as many factors have been playing in, but very positive, as you had highlighted, that it is time to be cautious but optimistic, and you would be rather slightly more bullish for the medium and long term than be bearish. And I think we take that to heart, and that's something which we have been slowly building our portfolios across the clients with that thought. So thanks a lot, really appreciate it. Thanks a lot to all our guests who have joined in, and have a good weekend.
Thank you, Harsha, and thank you,
Amitabh.
everyone.
Thank you, Anilika, and thanks everyone. Have a very good
everyone. Good day. Good.
Bye.